Citadel is getting kicked out of the Chinese stock exchanges. And silver is absolutely ripping faces off of shorts and off of some of these financial institutions. We're going to talk about both of these and other heavily shorted equities very briefly. This could be a super short one. Let's say 12 minutes here, tops. So check this out right here. China clamps down on high-speed traders. Let me go back. You don't need to see it that large. China clamps down on high-speed traders, removing data servers. Right? This post here from just a few moments ago on Bloomberg says that China's pulling the plug on a key advantage held by high-frequency traders, removing servers dedicated to those firms out of local exchanges' data centers. Right? So the commodities futures exchanges in Shanghai and Guangzhou are ordering local brokers, we're talking Citadel, to shift servers for their clients out of data centers, which was a move that has been led by regulators. So if the Chinese regulators understand that trading ahead of others with your high-frequency trading algorithms and systems is a problem, why isn't the Securities Exchange Commission doing the same? Why isn't the United States doing the same? Why isn't FINRA demanding the same? The Shanghai Futures Exchange told brokers they need to get equipment for high-speed clients out by the end of next month, while other clients need to do so by April 30th. So this clampdown is going to hit an army of high-frequency firms. Citadel Securities, Jane Street, Jump Trading are among some of the foreign firms whose access to these services is being affected. And of course, this is something that should have been done many, many years ago and should be done still, even now, here in the United States. Meanwhile, Chicago Metals Exchange has increased the margin requirements for gold and silver futures, as some of these banks and shorts are getting absolutely obliterated. Check this out. This means that the collateral actually scales with the price, folks. Right? This letter is from CME Group, and I'll just read it to you. You don't have to read their boring jargon. What it's saying is that if prices rise sharply, short sellers, those that are betting on the decline of a price, are going to face higher margins, potentially triggering margin calls. And in case you're unaware, this is something we've seen happen not once, not twice, but many times throughout history, folks. One second here, I got to check on something. All right, we are good. If you didn't know, they raised the requirements on December 27th, 25,000 per futures contract. 3 days later, on the 30th, they raised it to 32,500 per contract. And now again on January 13th, they didn't just raise it a fixed amount, ladies and gentlemen, but they raised it by a percentage of the contract's notional value. So what this means is that it will scale dynamically with the increasing in prices. So we're talking about a 5 and 9% increase, immediate increase, based on the notional contract value. Each one of these contracts for futures is indicative of 5,000 ounces of silver. So that was at 25K margin requirement, went up to 32.5K margin requirement, and now it's gone up again to $38.25 thousand in the margin requirement that they're seeing. Not to mention the United States Mint has just told customers that silver is breaking out and has stopped the sales of all numismatic silver. Numismatic means that it's collectible for a variety of reasons. A very high quality, specific rarity, etc. Think Walking Liberty, think American Eagle, etc. So what this means basically is that when the mint can't sell silver because the price is moving too fast, price discovery is no longer under Wall Street's control and has moved into the real world based off of physical. Physical silver has been tight and is getting tight. I'll help you put it on. Give me one moment, okay, baby? Give me 5 minutes. All right. Thanks. The paper prices of silver are not matching with real world demand. Suppliers cannot hedge fast enough, and the inventories are being drained. But the reality is, silver is not just moving because of physical, it is moving because there is insufficient physical to the massive amounts of shorts that have been taken out against it. We saw this same thing with Bear Stearns in 2008. And a lot of people right now are wondering, is TD Securities next? As you can see here, they took out a short position on January 11th, looking for silver to drop from what was then $78 to $40. And as you can tell, they fucked around and found out. And as of yesterday, January 15th, yesterday, I posted this. Silver short seller TD Securities is forced to close their short position against silver after getting smashed with millions of dollars in losses. They were in at around $78, expecting it to go down in price. And next thing you know, $89 came and ripped their faces off. Using Bear Stearns in '08 faced a $2.5 billion margin call on their silver short position because the price surged over $21 an ounce. JP Morgan took over that position, much like Citadel did with, what's their name? Oh, gee. I think you guys know exactly who I'm talking about. Citadel Securities bought a firm's position in 2021 again because to protect their short positions on GameStop and AMC and other heavily shorted equities, much like JP Morgan did in 2008 to prevent themselves from getting margin called due to a cascade of increasing prices and margin calls throughout the system. And of course, it took over a decade for Bear Stearns to get fined for this. And instead of RICO charges, they only got a slap on the wrist. And yeah, $920 million sounds like a lot. But when they are able to manipulate silver prices and paper and sell rehypothecations, lend out the same silver over and over again for over a decade, they likely made many, many billions of dollars.
Google something, and that is Chris Marcus, who runs Arcadia Economics YouTube channel, Bart Chilton, Chilton podcast, where a few years ago he came out and said and admitted many of these things, and unfortunately passed away under 2 weeks later. But he came out and said Bear Stearns largely failed because they had the largest short position really in the Colmex and in the history of it at that point. And when silver went to $21, they went bankrupt. And he comes out
$1. Oh my gosh.
He comes out and says this, and he says that they called Jamie Dimon into the office, and when they asked him, Jamie and Ben Bernanke, he says, it was me, Ben Bernanke, and Hank Paulson, the Treasury Secretary. And they said, Jamie, we need you to take this short position. And Jamie says, okay, guys, but I'll be in violation of position limits. They said, you got like 90 days to clean it up. Now, this is all coming from the head of the CFTC, Bart Chilton,
right?
And which is like the head of the SEC.
From the head of the Commodities Futures Trading Commission, specifically told us that we've seen it happen before. We're likely to see it happen again. I wonder just how many millions TD Securities lost. I wonder how many millions other big institutions and banks in the United States and around the world are losing because China and other governments are snatching up silver in absolutely massive ways. Speaking of other heavily shorted equities, AMC stock short interest is up to 103 million shares. Gee, if people were wondering why the stock price could possibly be dropping, maybe it's because there's been a 64% increase in that short interest. Remember, that is self-reported data. Institutions, brokerages, market makers, report, and hedge funds and so on, family offices, report their short positions to exchanges. And we've seen time and time again that they have been fined time and time again for lying about their actual short versus long positions. As you can see here, 103.71 million shares, 179 million shares on loan. That short interest, the number of shares increased, not 64%, up by 78.68% increase on the self-reported short interest on AMC, and people were wondering why the stock price was dropping. Well, folks, there's a lot of opportunity to be had, that's for sure. Meanwhile, love him or hate him, Donald Trump is actually a man of the people. Instead of giving money to insurance companies He is kicking them in the balls and kicking their stock price in the balls by giving that money directly to people.
Today, I'm thrilled to announce my plan to lower healthcare prices for all Americans and truly make healthcare affordable again. We're doing things that nobody's ever been able to do. We're calling it the Great Healthcare Plan. Instead of putting the needs of big corporations and special interests first, our plan finally puts you first and puts more money in your pocket.
Plain and simple. Let's summarize, right? Awesome post by Gunther here. Ends kickbacks to insurance brokers. It locks in massive prescription drug discounts. It forces the hospitals and insurance companies to publish claims versus profit breakdowns. Hospitals and insurers on Medicare and Medicaid have to post all their prices. So instead of giving this money to the big insurance companies to subsidize their pockets to be able to give you a cheaper rate, they're going to give you the money so that you can afford to shop around. And they will have to become more competitive because if one company doesn't, the other ones will. Meanwhile, no, don't do that, baby girl, please. Okay, thank you, sweetie. Jerome Powell is now under federal investigation for lying about how the $4 billion in renovations on the central bank's Washington headquarters was actually being spent. Originally, this was supposed to be about less than $1 billion. Trump's even said they're building a basement into the Potomac River. I could have told them that's very tough to do, and it doesn't work, and it's very expensive. Trump continued, but they're up to $4 billion, headed by this clown, referring to Jerome Powell. And Jerome Powell, of course, is trying to walk back the statements and pretend like Donald Trump is not upset about $4 billion worth of money printed out of thin air is being spent on this ridiculous building, which could build 2 brand new football stadiums, by the way. Instead, he says, quote, Powell stated, this is about whether the Fed will be able to continue to set interest rates or whether instead monetary policy will be directed by political pressure or intimidation. I think that Jay Powell is in for some serious news here with this investigation, and he is not going to like the outcome. Meanwhile, the Crypto Clarity Act, folks, 53 banks are writing themselves a $6.6 trillion bill. That's right, ladies and gentlemen. The Clarity Act is not really helping retail investors in the way that banks want you to believe. You like yield on your stable coins? Well, the banks want to take that away because they don't think that you should be able to get yield for letting your stable coin sit idle. You should have it deposited in your bank so they can give you a 0.1% interest and pocket the remaining 4.5% interest from the Treasury. And if stable coins could pass that yield to users such as yourself, just for owning and holding some crypto, in the same way that you now own and hold fiat currency, well, then they could not compete. So they're making or trying to make this competition illegal. The Kansas City Fed has calculated what happens if stablecoins pay competitive rates. Banks lose 25.9% of deposits. Come here, baby. 25.9% of deposits could be lost by these banks. We're talking $1.5 trillion in lending capacity vanishes. Meanwhile, people are actually able to make money for themselves. How could that possibly be good for banks? How could that possibly be good for the 99? Again, this is not crypto regulation. This is making sure that banks make as much money as possible and protect their ability to make money. Meanwhile, you lose that ability. That's right, baby. So, this is why you deserve fair and transparent markets. Markets with no payment for order flow. Markets with no wholesalers like Citadel that are able to trade ahead of you by having their I can't find that post. There it is. This is no wholesalers prevents wholesalers like Citadel and Virtue from trading ahead of you by having their equipment inside the United States New York Stock Exchange and inside the NASDAQ or right up against to it. Because they can't buy your order from Lit Exchange, the way they can buy it from Robinhood and Schwab and Webull and E-Trade and so on. This prevents dark pools from being used to distort market prices. Period. Go to Lit Exchange app on Twitter. Go to litexchange.com and participate now. Kelsey, can you say Lit Exchange? Try again. Lit Exchange. That's pretty good. That's pretty good. So, this actually gives you an opportunity to invest in an upcoming stock and crypto brokerage and participate as an equity shareholder prior to launch and IPO. Check it out, folks. I do not think that you will regret it. I wish you peace and wealth. Have a great rest of your day, my friends. What's going on, Gary? What's going on, Alphas? It's good to see you, ladies and gentlemen. You gonna say hi? You gonna say hi to everybody? Come here, here. You can say hi. There you are. There you are. Look at you. You're on YouTube right there. Is that my pretty baby? This little girl, for those of you that have been with us on the channel for a period of several years, this is the little girl that is in my, the baby that I'm holding in the picture for my profile pic. You guys have seen her from the day she was 1 day old. And as you can see, she is now 4, almost 5, and is an amazing part of my life, is my everything. This little girl is the reason that I believe that we need free and fair markets. She is the reason. I want her to be able to succeed and make money and be able to retire off of income that she has earned by profiting on the stock market, profiting in crypto, not by having her lose the ability to actually make money in the stock market because of wholesalers and trading ahead of regular retail investors, using dark pools to control market prices, rehypothecations on things like silver and gold, and this fake paper derivative garbage. It can't go on forever, folks, but it will if we don't do something to stop it.
Time to go back.
Let's go, baby, go. Let's go get your sister. If we don't do something to stop it, it's never going to end. All we have to do, route orders away from them, and it's completely legal. Completely legal. Nothing is stopping or forcing market makers or brokers from not interacting via payment for order flow. I can see you. It's simple greed. Robinhood makes the majority of their money from from selling your order to companies like Citadel and Virtue. Schwab, well, they make billions and billions and billions of dollars. Now, why would Citadel and Virtue and these other wholesalers buy your order? Well, folks, because they can profit off of it. They can trade ahead of you. They can create issues that could potentially be synthetic shares and then fail to deliver. And obviously that could be very, very profitable, as you've seen. So, all right, baby girl. My baby wants my attention, so I'm going to get out of here so I can give her the attention that she deserves. I wish you peace and wealth. Have a great day, folks. I'll do another video. Actually, my apologies. I am going to air the live stream that we did with Dr. Marco Metzler, PhD economist, on Monday. So if you want to see it, turn on notifications, click that stupid bell, subscribe, yada, yada. That stupid shit that people have to say, stupid stuff that people have to say. Hey, can you say goodbye? No, not to me, to them. Say bye. Say have a good weekend. Say see you on the moon.
You on the moon.
Much love, my friends. I will be solo on the next live stream so I can give you guys the attention that